Subscribe to our YouTube channel and don't forget to press the bell icon to get all the latest updates.
Against this backdrop, the Monetary Policy Committee decided to hold an off-cycle meeting on 2nd and 4th May 2022 to reassess the evolving inflation growth dynamics and the impact of the developments after the MPC meeting of 6th to 8th April 2022. Based on this assessment of the macroeconomic situation and the outlook, the Monetary Policy Committee voted unanimously to increase the policy repo rate by 40 basis points, by 40 basis points to 4.40% with immediate effect. Consequently, the standing deposit facility rate stands adjusted to 4.15% and the marginal standing facility rate and bank rate to 4.65%. The MPC also decided to unanimously remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within the target going forward while supporting growth. So the decision in this regard, what is called as the stance, is status quo. In other words, it's the same as was last time. I would now like to set out the rationale behind the MPC's decision and the stance. Globally, inflation is rising alarmingly and spreading fast. Geopolitical tensions are ratcheting up inflation to their highest levels in the last 3 to 4 decades in major economies, while moderating external demand. Global crude prices, that is crude oil prices, are ruling above $100 per barrel, and they remain volatile. Global food prices touched a new record in March and have firmed up even further since then. Inflation-sensitive items relevant to India, such as edible oils, are facing shortages due to conflict in Europe and export ban by key producers. The jump in fertilizer prices and other input costs has a direct impact on food prices in India. Further, the normalization of monetary policy in major advanced economies is now expected to gain pace significantly, both in terms of rate increases and unwinding of quantitative easing as well as rollout of quantitative tightening. These developments would have ominous implications for emerging economies, including India. Meanwhile, COVID-19 infections and lockdowns in major global production hubs are likely to accentuate global supply chain bottlenecks while depressing growth. In fact, global growth projections have been revised downwards by up to 100 basis points for this calendar year. These dynamics pose upside risks to India's inflation trajectory set out in the MPC resolution of April. Further, the MPC noted that domestic economic activity is progressing broadly on the lines anticipated in April. Contact-intensive services are benefiting from pent-up demand, and investment activity is showing some signs of gaining traction. At the same time, the MPC judged that the inflation outlook warrants an appropriate and timely response through resolute and calibrated steps to ensure that second-round effects of supply-side shocks on the economy are contained and long-term inflation expectations are kept firmly anchored. In the MPC's view, monetary policy response at this juncture would help to preserve macro-financial stability amidst increasing volatility in financial markets. Accordingly, the MPC decided to increase the policy repo rate by 40 basis points, and it also decided to remain accommodative while focusing on withdrawal of accommodation to ensure that inflation remains within target going forward while supporting growth. Let me now elaborate further on the outlook for growth and inflation. I would now first like to focus on growth. In this high voltage global environment, it is useful to take stock of domestic macroeconomic and financial conditions. The rebound in domestic economic activity that took hold with the ebbing of the Omicron wave is turning out to be increasingly broad-based. Private consumption is regaining traction on the back of recuperating contact-intensive services and rising discretionary spending. The forecast of a normal southwest monsoon in 2022 for the fourth successive year has brightened agricultural prospects, and this should support rural consumption. There are also signs of an incipient revival taking place in the investment cycle. This is reflected in high-frequency indicators like imports and production of capital goods, rising capacity utilization supported by conducive financial conditions, and stronger corporate sector balance sheets. Export growth has remained buoyant, while persisting high growth in non-oil, non-gold imports reflects a durable revival in domestic demand. Even as the drivers of domestic economic activity are getting stronger, they face headwinds from global spillovers in the form of protracted and intensifying geopolitical tensions, elevated commodity prices, COVID-19 related lockdowns or restrictions in some major economies, slowing external demand, and tightening global financial conditions on the back of monetary policy normalization in advanced economies. These risks are evolving on the lines anticipated in April 2022 statement and appear to be lingering.
It's great to see you here. Thank you for watching our work. If you haven't subscribed yet, don't forget to click the bell icon and subscribe to Mojo Story and support independent, robust journalism.